This is Nick Radge, manager of the Harbourside Direct Equities Satellite Strategy. Today we're going to be talking about the markets in May and the performance of the portfolio. Very quiet, not much to actually report. We did retain a cash position, 100% cash position, mainly due to the ongoing trends that just weren't enough on the upside to pull us back into the market. So the portfolio returned just a little over break even for the month, and the small ordinaries closed 5.8% higher on a very, very strong US market. I believe the US markets posted their strongest gains for May in 35 years. So it was a V-shaped recovery. Look, we have built this strategy to invest in longer term trends. We haven't built it to invest in short-term chaotic periods of time like we've seen over April and May. The V-shaped recovery is really not a concern for us. It may appear in hindsight, obviously, that we've missed out on a good opportunity, but the important thing to remember is that in 2020, we were exactly in the same position. May 2020, whilst the satellite strategy wasn't in use back then, we had a similar strategy that was investing in the ASX, and about the same time of year, end of May, that portfolio was about down 8% or so. But the momentum in the latter part of the year saw that portfolio recovery very, very quickly and finished up the year for the last 6 months up 59%. Now, there's no way I'm suggesting that's going to occur here, but you never know what could happen, and the kinds of portfolios can play catch up very, very quickly. Small caps are approaching all-time highs. That's good, and the US markets are looking very, very strong. Now, one of the most important things of this portfolio for your clients is the correlation and their respective drivers. We try to be a little bit different to your standard funds out there, and that offers a lower correlated product in a portfolio mix. So the drivers for the lower correlation is that the satellite strategy is index unaware. That is, we're not buying stocks to replicate the index and then tweaking them. We're using a top-down approach and trading momentum accordingly. Secondly, we do not do cap-weighted position sizing like many other funds do. So we are equal weight across the board. Agreeably, that in the US market especially, that's been a very, very narrow field, and probably more so in the Australian market as well over the last few years, and that's what's made it a little bit more difficult. And more importantly, probably, is our defensive mandate. We do have a mandate to go to 100% cash. We've seen that in the last couple of months. When markets are selling off, we do look very, very good, but obviously when you get V-shaped recovery, it doesn't look as good. But in sustained bear markets, such as what we saw back in 2008 or 2002, 2003, these kind of portfolios will actually perform quite well. And also in lost decade periods of time, which I've written about recently, we have extended periods of time of no returns, and we can go back to 1968 to 1982 in the US market, 2000 through to 2013 as well. These portfolios actually outperform considerably to a standard buy and hold. So as you can see here, the satellite strategy, the correlation to the small odds 0.49, but very importantly on the downside is where it really comes into play. So when markets are weak and trending down or in panic stages, the satellite portfolio has a correlation of 0.13 to buy and hold. And that in a small allocation to a client portfolio can be very, very beneficial. So all in all, look, it was one of those months. As I said, we build these strategies for long-term momentum and long-term trends, not for the short-term chaos that we've seen in the last few months. So we'll see what happens for the rest of the year, but at this stage, it's all looking very, very promising for higher prices. As usual, if you have any questions, feel free to email me, nick@thechartist.com.au.